Have you ever wondered what happens when the Fed raises interest rates? How does it affect the markets we invest in? The goal of the Federal Reserve is to maintain the US economy at a healthy level, not too hot, not too cold, but just right. Economic instability is threatened when the economy is booming and running hot, as inflation and asset bubbles can spiral out of control. When this happens, the Fed intervenes by raising interest rates, which aids in slowing the economy and maintaining steady growth. But how exactly does it affect the stock market, and how does it affect crypto and your normal life? Well, this is shocking. It's just awkward realizing our monetary system. But let me show you how you can beat the matrix, giving you an edge over the system. In order to lower the cost of borrowing money for people and businesses, the Fed may lower the federal funds rate if it thinks the economy is underperforming. Usually, this action raises stock values, giving investors higher returns. The Fed, however, hikes interest rates to cool things down when inflation becomes out of control or asset bubbles spiral out of control. An increase in rates has an impact on the overall economy. Rising mortgages, auto, and business interest rates slow down cash flows. This may cause companies to alter or postpone their expansion strategies, hence earning less than the investors anticipated. Higher interest rates encourage investors to sell assets and take profits in the stock market, particularly during periods like these where stocks have experienced several years of double-digit percentage returns. As you might expect, investor moves like this have the potential to reduce stock prices, if not across the board, then at least individually. On the other side, the expected amount of future cash flows will decrease if a company is perceived to be slowing down its growth or is less profitable, either through debt expenses or less income. In all other respects, this will result in a decrease in the stock price of the company. The Dow Jones Industrial Average, S&P 500, and other prominent indices that many people connect with the market will fall if enough companies see a reduction in the value of their stock. Investors won't see as much increase from stock price rises if they have lower expectations for a company's expansion and future cash flows. As a result, owning stocks will become less appealing. Moreover, when compared to other assets, investing in stocks can be seen as being too risky. Exactly what happens in the stock market happens in the crypto market. However, the crypto market is much more volatile than the stock market, so there are more losses in the crypto market when the Fed raises interest rates than in the stock market. Higher interest rates may also be advantageous for savers, but may be detrimental to borrowers. That's because the federal funds rate also serves as a benchmark for yearly percentage rates on deposit accounts. Banks increase your deposit account earnings when their FOMC hikes interest rates. As a result, the APYs on your savings, checking, certificates of deposit, and money market accounts also increase. Because online banks compete fiercely for deposits, online savings accounts typically respond to changes in the Fed rate very quickly. Even in the best of times, the APYs provided by traditional brick-and-mortar banks don't often rise particularly high. Instead, they react to rate hikes far more slowly. And suddenly, guess what? Many are then concerned that a recession is imminent despite the Fed's efforts to achieve a soft landing for the economy by decreasing inflation towards 2% without starting one. According to many experts, the bank's benchmark federal funds will keep increasing all year long, but it's possible for the economy to enter a recession if the Fed raises rates too quickly and excessively. As previously discussed, higher interest rates increase the cost of debt and make borrowing more difficult for both individuals and businesses. That can result in numerous job losses, pressure on the stock market, and monetary hardship for millions of Americans. Even though it isn't official, many people believe that the United States is already in a recession and they're preparing for the worst. From Apple to Google, major tech companies have declared that they're halting hiring plans, and other businesses have already announced layoffs. Even if the labor market was still close to a record high in August, labor expert Andrew Stetner believes it will be much weaker next year. Now you might be wondering, what is the best investment when interest rates are rising? Well, shorter-term bonds are frequently preferred since long-term rates carry higher risks. Make sure you consider government bonds designed specifically to combat inflation if rates are rising as a result. Last but not least, you can certainly think about shorting the stock market if you think that rising interest rates will harm the value of your stocks. I mean, why not? Anyway, that's all. And have you ever wondered how to make profit from the stock market and earn 1,000 times returns? Well, be sure to watch this video and don't forget to subscribe.